So what we are going to discuss now is I think our chapter number next. I don't know which chapter now, but I think it will be chapter 5. Now we start. Let's first discuss the capital structure bit, then we can go to, because I want to combine investment appraisal with the APV. Let me start briefly. I think it can take us like 1.5 hours. Capital structure. Then after that, we can discuss investment appraisal. But this may be chapter number 4. Maybe we can combine it. And we call it gearing and the capital structure. So we have talked about gearing in our previous part. So I just want us to just briefly to talk about it, because we are not, last time we talked about the operating gearing and the financial gearing. So when it comes to gearing, we look at how the company's activities are affected by both the financial and operating gearing. So gearing is the level at which the company's activities is affected by both the financial and the operating gearing. We talked about this. You are looking at how the company's activities will be affected by both the operating and the financial gearing. And if you remember, when it comes to financial gearing, we said, we talked about this, is the level at which the business activities is affected, is financed by borrowed funds. The level at which the business activities are financed by borrowed funds, it's going to define your gearing. And
excuse me, sir.
Yes.
The first sentence
is incomplete.
The first sentence is there's a repeat.
Okay, let me check.
Repetition of.
Okay. Fraud. Is affected by both financial and operating gearing. Which sentence?
Those the word gearing is coming. What is explaining what?
We are not in English competition. So Yeah, the word gearing is coming twice, but what I wanted to mean when it comes to, because in most cases we only look at financial gearing, but when you talk of gearing, it is both financial, maybe it is both financial and operating, and that's now what I'm trying to go down to explain. If you talk of financial gearing, what do you mean by financial gearing? And when we talk of operating gearing, what do you mean by operating gearing? But in gearing, in general, you are looking at it in terms of financial and operating.
Then what is gearing?
Gearing, I don't want to say, in most cases, we define gearing as the level of debt, the proportion of debt to equity, the proportion of debt in the business, or including a debt in the capital structure. That's how we define the gearing. But that is part of financial gearing. That's what I want. I want to avoid that. So maybe you can say, is it gearing in terms of financial and operating? Because when you say financial gearing, that's when you are looking at how you're financing your activities with a debt. But when it comes to operating, you are looking at the fixed costs. How your fixed costs affecting your business activities. I don't know if you have got me in that aspect. Yes, the word gearing for the English part, but I'm trying to define it in that context.
Now, if you say that the level at which the company activities is affected, when you talk about being affected, you mean what?
That's the financial gearing. Now you are looking at it in terms of your level of debt, how much debt you have in the business activities. Then when it comes to operating, you are looking at the fixed costs. What are the fixed costs that you have in your business activities?
Oh, okay.
Yes. And I want to look at it in that context. And we have already looked at this in our previous part in the financial analysis, where we said our financial gearing is equal to EBIT divided by EBT, if you remember that. This one we talked about it. And another one we talked about is our gearing level, where we said it's the market value of debt. You remember? Over market value of debt plus market value of equity. This one we talked about them when we are discussing, and it's not my interest in today, but of course I can talk about it.
But the formula, yes, we have it in our book. But we need to understand why, when you take profit before interest and tax, divide the profit before tax, you measure the gearing.
Yes. How? Because now, how do you get your let's look at this. Let's say that you are financing your business. Business is ungeared. Let's say that you have an ungeared business. If the business is ungeared, it means your EBT will be equal to EBIT. So in that case, it will be equal to 1. If the business is an EBIT, the EBT will be equal to EBIT, and it will be equal to 1. It means you have a business which is not geared because you're not paying any finance cost. Are you getting me now?
Not really as such, because that equality, is
Let's say, how do I get, if I have gross profit, maybe if I can come from the gross profit, if I have the gross profit, you less the operating expenses, isn't it?
yes,
Operating expense, then what you get is the EBIT, isn't it?
yes, it is.
Now, from the EBIT, you less the finance cost. You less the finance cost. Then what you get is it? Is the EBIT. Now, if this is 0, if you're not using any debt in the business, it means
yes.
You get
That
it?
is clear now.
It is going to be, if you're not using any debt, that is going to be 0. Meaning that your EBIT will be equal to EBT, and which is going to be equal to 1 if you divide.
Yes.
It's okay? Now,
Yes.
if you are using a debt, if you are using a debt in the business, it means your EBT will be below. If you have a business, if you have a geared business, it means the EBT will be less than the EBIT. So it means when you divide, this will be greater than, it will be greater than 1.
Yes.
You get it?
Yes.
So that excess, it indicates the level of cost you are paying to the financiers, or the interest burden, or the debt burden that you are paying.
Okay.
Yes. Does it make sense now?
Yes.
So that is how you are going to, it's the same with, it's going to be the same with operating gearing, because operating gearing, you have this as your contribution, isn't it? Or your gross profit. You have this as your operating cost. If the operating costs are small, it means you'll have a high EBT. If the operating costs are high, you're going to have a low EBT. Yes, please. Okay, it is Wembabas. Wembabas, please report to Felix. So, that is going to mean that if you have a high operating cost, you will have a lower operating gearing. So I think that's what we looked at. So if you look at operating gearing, hope these ones are allowed. Francis Akarim. So you are going to have an operating gearing. We say it is the level at which the company's activities is affected by the fixed costs. And we said you're going to get contribution. Our operating gearing, if you remember, we said it's the contribution divided by our EBIT.
Excuse me.
Yes.
And operating gearing, the activities affected by fixed what?
Fixed costs.
Okay.
So you are looking at how much of your profit is taken up by the fixed costs.
Okay.
So having a high operating gearing, it means you are having low fixed costs. Having a lower operating gearing, it means you are having a high fixed costs. I think we talked about this in our last class. So, and I just wanted to remind you, because we talked about this. But my interest, Jean-Paul, now, my interest is to apply this, the asset and the equity beta. Asset and equity beta. Now, when we say an asset beta or we talk about equity beta, asset beta is a beta of a business that is not geared. If you have a business that is not geared, which has no debt or financially geared, in that case we call it an asset beta. Is it okay? So if you go to asset beta, please, this is very, is the beta of a business that is not financially, if you put that, financially geared, meaning the business is ungeared. It does not use any debt. In that case, you'll have an asset beta. And how do you get the asset beta? How do you get the asset beta? So if you have to compute an asset beta, that's how we abbreviate. will be equal to an equity beta times value of equity over value of equity plus value of debt into 1 minus t. Please, when you are dealing with a business that is not geared, you must use an asset beta. Even when you are determining the cost of capital, cost of equity, and the business is not geared, you must get, so BA, this one, BA is the asset beta and BE is the equity beta. VE is the value of debt, value of equity, sorry, and VD is the value of debt. T is the corporate tax. I think that one we know. T is the corporate tax. So please, when you are dealing with a business that is not geared, when you are determining the cost, you should use an asset beta. If you are dealing with a business that is geared, then you are going to do an equity beta.
Excuse me, sir.
Yes, yes.
What is the indicator of a business who is geared?
As long as a business has got a debt in its capital structure, the moment you see a debt in the capital structure, it means that the business is geared.
Okay.
Yes. As long as there is a debt in the capital structure, the business is geared. And in that case, you are supposed to use an equity beta.
Excuse me.
Yes, please.
You have said that BA is beta of asset is the business that is not financially geared. What about beta of equity?
It is that's what we are going to define now.
Okay.
When you say value of equity or value of debt, you mean market value or book value?
The market value. But that's going to depend on the question that you are answering. Somewhere you may need the book value, others you may need to use the market value.
Both are accepted.
It depends on the answer you are answering, the question you are answering. Example, like maybe, is it the previous, where they asked to re-gear? You first use the book value, then you go to the market values. Is a beta of the business which is financially geared. The moment you have a debt in the capital structure, in that case, you have an equity beta. Even the cost should be the cost of a business that is geared. The moment you have a debt in your capital structure, in that case, you are dealing with a business which is geared. And how do we get an equity beta?
It is asset beta Asset beta times
You are just now rearranging
yeah
asset beta, rearrange
times the value of equity plus
value of
debt
equity plus value of debt into
over value
again
of equity.
minus T. Then the whole of this I divide by VE. I think I've already defined that. Please, it is very important when you are dealing with this, more especially in the cost of capital, cost of valuation, to identify whether you are dealing with an asset, with a geared business, or you are dealing with an geared business. If you are dealing with a geared business, you must use an equity beta to value. If you are using with a geared business, you must use an asset beta. So it is very, very important when you are determining the value of a business.
But when you are dealing with the investment appraisal, you use the asset beta.
If you are using an investment appraisal of which business? Of an geared? For example, when you are in APV, if you are in APV and you first use an asset beta, probably if you want to get the cost of an geared business, you first use an asset beta, and because we are going to discuss that in investment appraisal. So let's see. Capital structure theory.
Sir,
Uh,
that formula, the asset beta is multiplying or?
Oh, yes, all.
Okay.
So the capital structure theories. Now, the capital structure theories, they try to explain whether the way you finance the business or whether the way the business is financed matters. That's the capital structure theories. The way you finance your business operation, does it matter? Whether you are using a debt or you are using an equity, does it have any effect? So this try to explain whether the way the business is financed matters. The decision is made by analyzing the effect of capital structure on the value or on the cost of. Now, we are looking at the capital structure theories, and we are saying these capital structure theories, for them, they look at whether the way the business activities are financed matters. Someone who is using a debt and another one is using equity, does it matter in the way they finance their business activities? So when you are making a decision, when you're analyzing a decision, whether it matters, what you look at is the way the capital structure affects affect your cost of capital, or it affects the value of the business. If there is no effect, then it means it does not matter. But if it affects, then it means it matters. The way you finance your business matters. So what are the assumptions of the theory? Assumptions of the capital structure. Now, of course, each one, but the general assumptions of capital structure theories the general assumptions of the capital structure is that, number one, the business activities or the business activities are only affected by the financial risks. When we are analyzing this, we assume that the business activities will only be affected by the financial risks. And the financial risks arise from use of debt. Financial risks arise from the use of debt. The more debt you are going to employ into the business, the more the financial risks that you are going to meet. And another one, we assume that business risks, those are the other operating risks. Business risks are considered to be constant. Meaning that whatever decision we make, we are ignoring the business risks. The only risk that we assume that is going to affect the business activities is the financial risks. And the financial risks arise from the way you are going to employ the debt. The more debt you are going to employ into the business, the more the risks that you are going to meet. So what are these theories? So whatever we are discussing, the only risk that we are facing, so the capital structure theories or the types. Number one, we have the traditional theory. Number two, we have the Modiglian and the mirror theory. Mirror theories, these are many. Modiglian and the mirror theories. We have the modern trade-offs. Modern trade-off theory. We have the pecking order theory. Pecking order theory. So these are theories which tries to explain whether there is an effect on the way the business activities are financed. Now, if you look at this,
Excuse me.
Yes, please.
Yeah, when you say business risk, you refer to the operating gearing.
Operating gearings.
Okay.
And the others like inflation, those are the one which causes the operating gearing. Inflation, those what we all consider them to be constant. Now, if you look at the first one, we are going to look at the traditional theory. Because remember our decision, we are looking at how the capital structure is affected. And if you look at this theory, the traditional theory, it says that according to this theory, capital structure and the value of the firm are related. When this theory, we say that the capital structure and the value of the firm are related. So the optimal value is determined at the minimum point of the cost of capital. So if you follow the traditional theory, for them they say the capital structure and the value of the firm are related, and you can determine the optimal value at the minimum point of the cost of capital. So if you look at that, I don't know if I can illustrate that, but if you are to illustrate, if I can illustrate this, I don't know. If I can illustrate this briefly. So at first, the cost of capital and the cost of debt are constant. These two costs are constant at first. But as you are increasing more debt, this one increases. So you have this one increasing, and you can also have this one. Ooh. This one also increasing. So when these two costs are constant, your wachacha is going down. The wachacha is going down. But an increase in these two costs causes this one also to go up. So this one is your KE. This is the KD. This is the wachacha. So at the minimum point,
that is what you call that the capital structure and the value of the firm are related.
Yeah, because you see that as the KE and the KD are constant, your overall cost of capital is going down. But as KD and the KE is increasing, the overall cost of capital also goes up. That's why we say capital structure and the cost of capital and the value of the firm are related.
Between the three, what indicates the value of the firm?
Yes?
Between the three curve, which one represents the value?
If you read this point, at the minimum point. So what is the minimum point of cost of capital? from the economics. Where do you get the minimum point? At this point, isn't it? That's where you can determine the company value at that point. Does it make sense?
It means the value of the firm, the point at which the cost of equity is equal to.
At the minimum point of overall cost. We are looking at the overall cost. Are you getting me?
Not clearly.
So if you look at this, this curve of the traditional theory, if you look at the traditional theory, for them their concept is the capital structure, value of firm, and the cost of capital are related. There is a relationship between the three. Our cost of capital is the wachacha, isn't it? When you say cost of capital, you mean the wachacha.
Yes.
Isn't it?
Yes.
So as the KE and the KD are constant, the overall cost is going down. What causes this overall cost to go down is the cost of debt. The cost of debt is cheaper compared to the cost of equity.
Okay.
So because of this, but as you are increasing more debt, you are increasing the financial risks we have talked about.
Yes.
So because you have increased more debt, the debt becomes too much. The equity holders and debt holders will demand a high return to be compensated with the financial risks. So because of the increase in the financial risks, the overall cost of capital goes up. So at the minimum point, the cost or the optimal value.
Okay.
I can write two lines as KE and the KD are constant. Wachacha is moving, is going down, or is decreasing. Due to please mute the benefits of using a debt. As more debt is increased, financial risks increases, which leads to an increase in KE, KD, and the wachacha. The value is determined at the minimum point of wachacha. So at the minimum point of wachacha, that's where you're going to determine the value. So that is now. Of course, before you look at assumption, I want you to look at this question. I'm going to copy it. I'm going to copy the question, and I want you to look at it and maybe tell me how you can handle. Let me copy this question. I don't know if that it has copied certain other part, but okay, my part I want is more is more clear. It is a question of August 2021. August 2021. I want you to look at this and then see how you can handle this question basing on this, on the traditional theory that we are talking about here. The Terembele Limited is a company established in Rwanda producing a range of fast-moving consumer goods to medium enterprises. The corporate financial director of the Terembele Limited wishes to find the company's optimal capital structure. Are we there? The company has ungeared equity beta. That is a very good information. Ungeared equity beta. You have our asset beta. If I'm to summarize the data here, I have an asset beta. BA is given as 0.85. That's the asset beta. Now, I don't want to take a lot of time on this. The risk-free rate is 6%, and the market return is 14%. Our risk-free rate, I said what, 6%, and our market return is 14%. Our tax, the tax is 30%. That's the tax. Now, if you come down here, the cost of debt varies according to the level of gearing and the company as follows. When the debt is 10%, the percentage of debt is 10%, the pre-tax cost of debt, I want to look at that. When VD is 10%, our KD, but pre-tax, KD but pre, meaning they have not adjusted the tax, is how much? Our KD is 6.5%. 6.5%. So now, if you look at this, what is missing? The question wants us to get the optimal. Estimate the company's optimal weighted average cost of capital and the optimal capital structure from the above information. And if you read our traditional theory, what is the optimal capital structure? The optimal capital structure is where you have the minimum cost. That's where there is an optimal capital structure, where you get the minimum cost. But what we have been given here, you have been given an asset beta, and the business is geared by 10%. So it means my VE from this, VE is 90%. So what do we need to get? Because you have a pre-tax cost of debt. So what I need to get the KE, which will be a risk-free rate plus an equity beta, because it is a geared business, an equity beta into the market return minus risk-free rate. Turi kumwe?
Yego.
So, what do we need in this example? You have a risk-free rate, you have a market return, but you don't have an equity beta. So meaning that you are supposed to compute an equity beta. And how are you going to get the equity beta? From our formula. Our equity beta is equal to
asset beta
into
value of plus the cost value of debt into 1 minus 0.5
then
over value of equity.
Over value of equity. So you can substitute, I think. So our BE will be, if we substitute, we have an asset beta 0.85. Seriously?
Yes.
Into VE is 0.9.
0.046.
VE is 0.9 because the debt is 10%. So automatically VE is 0.9.
Yes.
Yes.
Plus VD 0.1.
0.1.
0.1 into
1
0.7.
0.3. Then I divide by
0.9.
and you get what? Your BE. Remember, let's move. This is not our daily. You get? Ulikubona ngapi? Yes?
0.9.
You got what?
0.93.
0.9 what? 2.
3.
Okay, almost there. Maybe one I've rounded off. Now, once I have this, I can now compute my KE. What will be the KE? Risk-free rate 0.06 plus 0.93 into 0.14 minus 0.06. So what is your KE?
The BE is 0.92.
Not 93.
No.
Even if you round off?
Yes.
Let's move, members. We are taking time. K easy. Let's write that one. 13%. So what is
30.4.
13.4?
Yes.
You can get the KD, which is to simplify. You can get the KD, which is post-tax, which will be 0.065 into 1 minus 0.3. You get what?
Excuse me, sir.
Yes, please.
Is the equity exempted from tax?
Huh? KD, sorry. Is KD. KD, which is post-tax.
Okay. Thank you.
You get what?
4.5.
4.5%. So what is going to be our chacha? Can you say the source here? The weight, the cost, then the wachacha. I have equity. Weight is 0.9. The cost is 0.134. Our debt, the weight is 0.1. The cost is 0.045. So what do you get here? This times this. This times this. That is the first one. Now, that's the cost. If our debt is 10% and the equity is 19%. Yes?
Nushaka kuzajya winjira hano uzajya ufungura haba hakinguye keretse ntakinze bishaka.
So now we are not going to complete the whole company, but I want you to show you. Now, if we go to this one, the debt is 20%, and the cost of debt is 7.1. What will be the wachacha? If you go to the second one, VD is 20%. VE will be 80%.
I think it would be wrong to select this kind of question.
Yeah?
If this is not mandatory, number one.
But remember that is the one which can be our Jesus.
No, 12 marks with this long calculation.
Yeah, it was given low marks with very many calculations. I don't know how they calculated it. 7.1. I think now you can give me the what? This is 7.1. Our BA was 0.85. Is it like that?
Yes.
So what is the BE? Can you calculate it on your calculator? using the formula we have looked at. I'm waiting. I'm waiting your BE.
What is the cost of equity?
That's the one I cannot calculate until I get the BE. So I'm waiting to give me the BE. I think we are only going to look at these two levels. Remember, you are taking time to calculate BE. You had 0.85, I think, isn't it? Into 0.8 plus 0.2, 1 minus 0.3. Yeah, I want to hear what is the BE you get.
0.99.
Like that.
Yes.
I've already submitted it here. If it is, so what will be your KE?
$13.9.
13.9. And I think you can get the KD, which is post-tax. It will be 0.071 into 1 minus 0.3. And you get what?
I think equity beta
4 point,
is wrongly calculated.
you can round it to 5.
You got what?
It is 4.97.
Okay.
You can round it to 5.
479. Let's leave it. 497 is 479.
No, 97.
Okay, let's.
It is
Some people are challenging the equity beta. They are saying it's not correct.
Yes, it is 0.799.
It cannot. Do you know why I said it cannot?
Mm-hmm.
Equity beta cannot go below an asset better?
Yeah, I forgot to divide 0.8.
Yeah, okay. So what I
You
want
can.
to
It's okay.
my
It's okay.
my interest is to show you how do we use this to get the optimal capital structure. So if we take this again, we are going to have this as a 0.8.
8,
This is 0.2.
2.
This will be, we got what? 0.139, but this was 0.0497. So from here, you see that this is your wachacha. If I take these 2 points, where the VD is 10 and the VE is 90, and where VD is 20 and the VE is 80, it means this is going to be the optimal capital, cost of capital, the minimum. And
Sorry,
it
sir,
means,
there is a zero
eh?
on the debt. It
On
is
what?
zero on the debt. It is 0.0496.
0.0?
Yes, there is 2 zeros.
There are 2 zeros.
Yes.
No. There's 1.
Maybe here.
Yes.
I think you can go down to look for other parts. But I want you to look at this and apply the traditional theory to explain this.
Okay.
If you apply the traditional theory to explain this part. So it means if I compare these 2 levels, yes, if I compare these 2 levels, my optimal capital structure will be, if I compare it, I take only the 2 levels, the optimal capital structure will be 80% equity and 20% debt. Because that's where I have the minimum cost of capital.
Okay. Help us to copy up.
Eh?
You scroll up to enable us copy.
Up to,
Excuse sir.
Up.
yes, please.
Below the graph.
According to my understanding, I was thinking that the optimal capital structure should be on the first, because it's here we have a less.
Is it the less cost? That's why you have a less cost. Check the. What is the cost when you have 10 and 90? When you are using 10% debt and 90% equity, what is the cost?
Because you have 12.5, I think.
12.5. And what is the cost when you are using? So which one is the minimum? Is it okay?
Yes, it's okay.
But let's move so that we can finish this cost of capital. Capital structure today. When we meet on Sunday, we discuss investment.
Give us 2 minutes.
Excuse me, sir.
Yes, please.
You said when the debt increases,
Uh,
the weighted average cost also increases.
No, you will reach a certain point. I didn't say that. So if you got down, for example, if you finish this question, if you finish this question, if you finish this question, you are going to get to the optimum. Now it is decreasing because we said at first your K is decreasing.
Yes.
It's okay, but you are going to reach a certain point. A more increase in the debt leads to an increase in the KD or the Wachacha. So if you finish this, we will get to the optimal point. What's the optimal point?
Okay.
Yeah. You can go on and see. Suppose I use debt 70% and 30% equity. What will be the cost? Suppose I use, you will see that you will have a turning point. But here we have only taken two parts. So we are assuming our turning point is at that level.
Yes, excuse me.
Yes, please.
I want to ask a question on the last sentence or below that graph, where you have said the value of the farm is determined at the minimum point of Wachacha. Which value are you talking about?
The optimal value of the capital. That's what we call the optimal value. That's going to be the value. The optimal value. For example, here it is 20, VD is 20, value of debt is 20, and the VE is 20. That's the optimal value.
Okay. So in that case, the optimal value is the same as the minimum point.
It is at the minimum point of the cost. The optimal value is at the minimum point of cost of capital.
Okay.
Yes.
Scroll down.
Please, you can finish the whole of this, and then you will see where is the optimal point. Is it okay?
Yes.
Yeah.
How do we determine the optimal point? Is it that one that has the small
where you will see
Wachacha?
the smallest Wachacha?
Okay.
That will be the optimal point, as per the traditional theory.
Yes.
Yes. having a class I record later. I'm having a class I record later. I will call later. Pump ya food. Oli pia tujja kwogerera. Can you move on, friends?
Paul, doctor, we have heard.
Yes?
We have heard Paul sana.
Okay.
Pole kabisa.
So let's look at the next. Let's look at the next part. The assumptions. Number one, we assume all profits are distributed as dividends. So in the traditional theory, we assume that all the profits you get is going to be distributed as a dividend. What does this one mean? It means the dividends will be equal to the earnings after tax. Are we getting each other? So the dividends, please mute, is equal to the EAT. The dividends will be equal to earnings after tax, because all the profit that you get will be distributed as dividends. Please mute when you are not asking a question. Number two, the investors are rational, meaning they are aiming to maximize their utility. That's what it means. When you say investors are rational, it means the aim of the investor is to maximize their wealth. So that is, investors are aiming at maximizing wealth. Then number three, the market is perfect. So the market is perfect, meaning there is free flow of information. We are assuming a perfect market where there is a free flow of information. So there is a free flow of information. So we assume that the market is perfect, and therefore there is a free flow of information in the market. So these are some of the assumptions on which we base on to make that conclusion. So how do we determine the value? If you want to determine the value or cost of equity, under traditional theory. So when you are determining the cost of equity under the traditional, remember all the earnings are distributed. So it means your KE will be equal to the earnings after tax, or what is the dividend, divided by the market value. Divided by market value of equity. Remember, we have said all the earnings are distributed as dividend. So because all the earnings are distributed as dividend, to get the cost of equity, you just get your earnings after tax, or what is going to be the dividend, divided by the market value of equity. Then you are going to get the cost of equity in this case. If I can take you the simple example as a summary of this. So company X uses both equity and the debt in the capital structure.
Lecturer,
Yes, please.
but this computation of equity, or of cost of equity, is different. I'm not talking about the numerator because it is already explained. But the denominator, the way we're computing the cost of equity,
In the other,
it
it's
was
not different, but
price.
it's not different, but only here is you are taking all the earnings after tax. That's the only issue.
So when you say over market value of equity, is it the same as
The
a
market
price?
But in that case, you multiply by the number, because here you are taking the total dividend, not the dividend per share. So you just get the market value, getting the price per share times the number of shares.
Okay.
Yes. So let's look at this. I have this data, and so it means if I'm to get the data that I have in the question, I need the EAT, which is the same as the dividend, because in the traditional theory, all the earnings are distributed as dividends. So I need this. I need to get the current market price of the share. My PO is 40, and the number of shares is 2 million. So meaning I can compute my VE, value of equity, which will be 40 is it 40 times 2 million. $40 times 2 million. I'm not. Then I have the value of debt, which will be 50M divided by the per value times 90. So 50 divided by 1,000 times. So I have the per value, which I need. I need the interest. My interest, or the coupon, will be the coupon rate times the per value, which is going to be, coupon rate is 12% times per value, which is 1,000. And I think we get 120. Since the debt is irredeemable, I have also my market price of the debt, the PO of the debt, which is 1090. So from this data, I can compute my KE, which we said it's going to be the dividend distributed, which will be 8,400 divided by the market value, which is 80 million. And I get this divided by this, which is 10.5%, I think. Then I also have, I need the KD, which will be the normal way we calculated, 120 into 1 minus 0.3, because it is irredeemable, divided by 1090. So I don't know what you get here. 120 divided by 1090 times 0.7. So I have 7.7, I think. So once I have that, then I can compute my I can compute my wachacha because that's the question they want us to get. So my wachacha will be, I have the source here, I have the value or the market value, I have the weight, I have the cost, I have the wachacha. So the source, we have equity. Equity has a market value of 80. Debt has a market value of this. So if I add here, because we need to increase the space a bit, it's going to move up. Some are moving away. I don't know now. The key important formula is moving away. I reduce the size, what? I reduce the size. Still. Okay, I will see after that how to make it fit in the line. So it means this will be this divided by this. And here, this divided by this. The normal we did yesterday. So my cost here of equity 0.105. And this is 0.077. So our wachacha will be this. Yesterday's class time was this. So if I add here, I get 0.9, which is this is the wachacha. I don't know if you have a question on that. Members? Any question? So that is how you can compute the cost if you are using the traditional theory. So the other part, don't know that what you need to look at, I think it is the cost of equity. The cost of debt, it depends on the debt that you are having. So another part is the Modigliani and the Miller theories. Modigliani and the Miller theories. We always abbreviate as theory. Modigliani and the Miller, we always abbreviate as So when I say I just mean Modigliani and the Miller. Because now we have M2, Modigliani and the daughter. Now we look at the Modigliani and the Miller. Now, in Modigliani and the Miller, still they are because what we are looking at these theories, whether the way you finance the business activities matters. And as we said, we analyze this by looking at the effect of capital structure on the value or the effect of capital structure on cost of capital. Now, Modigan and Miller have got two theories. They have a tax-free theory and a tax theory. In the tax-free theories, they ignored.
Now, excuse me.
Yes.
From this computation, for example, this example, can we conclude that
having a debt of 54 million, and this one is the optimal.
Yeah, does it matter at the first sentence?
No, in this case, you cannot, because you need to look at different levels. For example, if I increase my debt, what will be the effect on the cost?
Oh, okay.
Yes.
Okay.
So we are looking at Modigan and the Miller theories, and I was explaining that Modigan and the Miller have got two theories. There's Modigan and the Miller in a tax-free, and then Modigan and the Miller where they included tax. In a tax-free theory where they are ignoring the tax, the conclusion was there is no effect. When they consider the tax, they concluded that there is an effect. So we are looking at the two theories. So developed two theories. Which are, we have in a tax-free economy. That's number one. in a tax-free economy, and that's number two. in a tax economy. So those are the two theories for Modigan and Miller, where you have Modigan and Miller where there is no tax, and then Modigan and Miller where there is tax. So if you look at the first one, in a tax-free economy. In a tax-free economy. Now, in this theory, Modigan and Miller ignore the tax. That's one of the assumptions. They are assuming that there is no tax in the economy. So, under this theory, assumed an economy where there is no tax, and they developed two prepositions which are MM1 without tax and MM2
Proposition means the hypothesis.
MM2 without tax. So in here they have two prepositions. Even in the other theory, there are two prepositions. There's MM1 without tax and MM2 without tax. So remember, we are looking at an economy where there is no tax. And if you look at MM1 without tax, MM1 without tax. In MM1 without tax, Morgan and Miller are analyzing the effect of capital structure on the value of the firm. Whether capital, the way you finance the business matters. That is the MM1. So this analyzes the effect of capital structure on the value of the firm. Now, after carrying out an analysis, Morgan and Miller conclude that there is no effect. The way you finance the business does not matter. So, after the analysis, MM concluded that value of business and the capital structure are not related. Therefore, the value of a GRD business, which we abbreviate as VG, is equal to the value of an GRD.
I think there is an error. Two prepositions, which MM1 without tax and MM2 without tax. It is with tax, I think.
No, without. Maybe you say I repeated it. Maybe that's what you said. There are two prepositions, they are all looking at without, because we are in a tax-free.
Yeah, for MM2, also it is without tax.
It's without tax. One, it looks at effect of capital structure on the value. Another looks at, because our decision is based on two, the effect of capital structure on the value or effect of capital structure on the cost. So the MM1 without tax, it looks at the effect of capital structure on the value.
Maybe you highlight it in the title here. MM1 without tax.
No, we are in a tax-free economy. There is no tax. That's the MM in a tax-free. So
no, what I mean on the value. Yes, it's better you highlight it there.
That is,
yes, on that title. MM1 without tax.
But that's that's down. Look, lead it down. This analyzes the effect of capital structure on the
value of the firm.
Yes. So the value of a GRD business is equal to the value of an GRD business, which you write as VU, sorry. If the two business are in the same risk profile, so as long as the two businesses are in the same risk profile, then it does not matter how you finance your business. So we always say that the VG, the value of a GRD business, will always look equal to value of an GRD and a GRD business. As long as the two business, they are in the same risk profile. So it does not matter how you finance your business. That is the MM1 without tax. So capital structure, value of the firm are not related. Now, if you go to MM2, still without tax, MM2 without tax. MM2 without tax. So in the first MM1, we have said we analyze the effect of capital structure on the value. So this analyzes the effect of capital structure on cost of capital, on the cost of capital. Does the way you finance your business affect your cost of capital or not? So after the analysis, MM concluded capital structure that cost of capital
Excuse me, lecturer.
yes.
That conclusion of MM1 is not clear. They are saying at their conclusion, MM concludes the value of business and capital structure are not related. How is not related?
Because they are saying a value of a business that is geared is equal to the value of the business that is not geared.
That is what they're saying. They are not. The business value and the capital structure are not related.
Yeah, they are saying, in illustration of this, I never wanted to say, suppose you have two companies. You have company A and the company B. But these two companies are different on how they finance the asset. Company A financed the asset using a debt of 100 million. Over 100 million. That's the illustration of the. This one finance its business using a debt of 10 million. This one finance using equity. It uses equity 10. And this one uses equity 100 million. Is the true value of this business different? Is there any difference in the value of this business?
Difference in terms of what?
Value. If you are financing an asset, you are financing an asset using 100 million debt, and this one financed an asset using 100 million equity.
The same.
So at the end, the value of the asset is going to be the same. But what is the only difference is the way you financed it.
Yes.
So they are concluding that a value of a GRD business will always equal to the value of an GRD business if their risk profile is the same.
Now, in this case, what is the risk profile for A and B? I think it's not the same.
As long as the two are in the same risk bracket, they are.
You mean?
We are saying as long as they are in the same risk bracket, maybe if the way they accept risk is the same, then it does not matter how you finance.
Is it the same? One is having 10 million debt, the other one 100 million debt.
Yes?
Is it the same?
The financial risks may be different. What about
Yes.
other risks?
Which one?
Although we consider the financial risks is different, but the way we accept risk may be the same. That I can still go up to 100 million risk profile, risk appetite for debt. Yes, so it's not going to have an effect on the corporate value, as long as our risk appetite is the same.
Okay.
So that is the MM1. So the issue is it does not look at how you finance the asset, because at the end, the value of the asset is going to be the same. Now, if you look at the second one, which is MM2, we are saying we are looking at the effect of capital structure on the cost of capital. How does capital structure affect the cost of capital? So if you look at this analysis, you find that capital structure and the cost of capital are not related. Are not related. Please mute. So the capital structure and the cost of capital are not related. So now, if I take this illustration, maybe I can draw another graph to illustrate this. This is my, let me say this graph to illustrate this Morgan and the Miller. And this is the cost of debt. Then this is my KE. And this is my Wachacha. So this is your Wachacha. This is the KD. And this is the KE, which is equal to KU plus KU minus KD times D over equity. Now this part, this one inside here, I don't know how I can write here. This part is what called the risk premium. It's a risky premium. This part inside here. Now, I want to explain this. KU is the cost of an geared. KE is cost of a geared business. Cost of equity of a geared business. Cost of equity of geared. Then KU is cost of equity of an geared. D is the debt, the value of debt. Value of debt. And E is the value of equity. think those ones. Those are the variables we have. Now, if you look at this, the moment you introduce a debt in your capital structure, automatically KE is going to increase. The moment you introduce a debt or introduce the gearing, the financial gearing, your cost of equity is going to increase. Is it okay? The cost of equity is going to increase. The moment you introduce a debt, your cost of equity will increase. So by this risk premium. But this risk premium is compensated by this cost of ungeared minus the cost of debt, because a cost of debt is cheaper. So because you are compensating the equity holders with the risk, the overall cost of capital does not change. Therefore, cost of capital and the capital structure are not related. Have we reached there? Members, have we reached there?
Yes, sir, we are there.
So when a debt is introduced into the capital structure, KE increases, reflecting the financial risks. But because the equity holders are compensated with KU minus KD into D over E, the wachacha remains unchanged. Therefore, cost of capital and the capital structure are not related. Have we got that? What is wrong? You are no longer saying a word.
We are following the same.
So can you look at an example? Maybe I can ask you this example.
It's you, sir.
Yes, please.
How can cost of equity being compensated with cost of ungeared business minus cost of debt?
Because the cost of debt is cheaper compared to the cost of an equity. So that benefit of using a cheap debt is what compensates the equity holders. Is it okay?
Yes.
Excuse me, sir.
Yes.
I'm confused. The cost of using equity is cheaper
The
than
cost of debt, no, it's the cost of debt that is cheaper, not the cost of equity.
The cost of debt is cheaper
compared to the cost of equity.
How? When we use debt, it means that you will pay interest. But when we use equity, it means that it is the shareholders is only.
Yes, I concur with you, but there are other. If you are issuing of equity has got a lot of transaction costs, which is not the same to the debt. A lot of transaction cost, issuing costs, which are not the same to the debt.
The debt, okay.
So it makes the cost of debt to be cheaper compared to the cost of equity. So I can challenge you with this. Company X is all geared. Is all geared business. So it's all ungeared. It's all ungeared business with cost of equity of 10%. And the market value of equity is, let's say, is 50 million. Let's assume that the market value of equity is 50 million. The company is introducing irredeemable, we're not going to calculate a lot, irredeemable debt with a market value of 150 and a par value of 1,000. The par valuation of the debt is $100 million. The interest rate on the debt is 7%. Compute the wachacha. Or show the effect of introducing a debt on the wachacha. Now, can you handle this? If you look at this, what is the current wachacha? We have a KU, which is 10%, which is the same as our current wachacha, because we don't have any other source. It's 10%. That's what it means. We have a VE, the current market value of equity, at 50 million. And what is the VD? My VD, the current value of the debt, will be 100 million divided by 1,000 times 1050. That's the current. What is going to be my interest? My interest will be 7%
times per value. 7% percent times per value.
times per value, which is 1,000, which is 70.
Yes.
So what will be the current cost of debt? Our KD will be 70
times 1 minus 0.
Where do you get that wachacha of 10% from?
We are looking at the first, before introducing the debt,
Yes.
there is no other cost of capital. You only have one source, which is equity. It means
Okay.
your KU is the same as the wachacha.
Okay.
Divided by what? By 1050. Isn't it? There is no tax. Remember? Isn't it?
Yes.
So what do you get?
0.66.
That's the current cost.
Yes, cost of debt.
$6.7. Now, what do we need? When you introduce the debt, you need to get KE.
Yes, cost of equity.
Isn't it?
Yes.
So we need to get the KE. When you introduce the debt, automatically the business becomes geared. You need to get the KE. And from our data, our KE is equal to KU plus KU minus KD.
KD.
Then
D over E.
D divided by E from the data. So what will be your KU? KE will be, if we substitute, KU 0.1. Isn't it?
Yes.
0.1 minus 0.67 times 105 million divided by 50 million, I think. Not like that? You get what? You get? Remember, as you are delaying, time is getting us.
$16.9. 16.9.
16.9. So this is the cost of a GRD business. I don't know if you have followed me in this. The moment
Excuse me.
Yes.
I want to know where you got cost of debt of 0.6.7.
I think it is here.
Oh, okay.
Yes. I want to emphasize this. The moment you introduce a debt, you need the cost of equity of a GRD business.
Can you explain more about that formula of cost of equity? which is equal to cost of an GIAT plus that other factor. Yeah, we need to understand the logic behind.
This formula comes from this Morgan and the Miller. If you followed it, comes from the Morgan and the Miller, that the cost of equity of a GIAT business, because if the business becomes GIAT, it will be equal to the cost of the GIAT plus the benefit of the debt. This one is the benefit of the debt, of using a debt. Does it make sense?
No. What is the benefit of using debt? Because it is cheaper than equity.
Yes. So if I have a debt of 10%, I'm using the equity 10%, and I want to employ debt which is 6%. It means you are going to enjoy the benefit of how much? 4%. So that one is the benefit of using the debt.
Okay. And
I was emphasizing this, that the moment you introduce a debt, remember what we were looking at when we were looking at the asset beta and the equity beta. The moment you introduce a debt in the business, automatically you need the cost of the equity of a GIAT. If the business is an GIAT, you only need the cost of an GIAT. But the moment you introduce a debt, now you need the cost of a business which is a GIAT.
Now, what is the indicator? For example, in an exam, when you are required to compute the cost of GIAT business. What indicator which shows you that you need to use that formula of Modiglian and Miller?
What can show me that I need to use, for example, if I have the cost of an GIAT business, is it okay? I have a cost of debt, but I don't have. I have a cost of a business that is not GIAT,
which is equity,
which is cost of equity of a business which is not GIAT, and I've introduced the debt. Automatically, I need the Morgan and the Miller formula.
Okay.
Yes.
So if I'm
yes.
So if I'm getting you well, if you introduce a debt, the value of the business increase.
Yeah, that's what we assume.
Okay. Even the cost of equity changes.
It changes.
Okay.
So now I can still now apply the what we were looking at, the source. I have the market value. I have the weight. I have the cost. Then I can have my. So the source will have equity. The market value of equity is this. I have a debt. The market value of debt is this. What is the weight? I can get the total here. The weight will be this divided by this. And this divided by this. The cost here, we've got 0.169. And here, 0.067. So what will be the wachacha? This times this. And here is this times this. So if I add here, what do I get? 9.99%, which is almost 10%. So what does this one imply? Remember we said, remember what we said in our analysis, that capital structure and the value of the firm are not related. Whether you are increasing a debt or what, the cost of capital is going to remain the same. So if you look at this, before introducing a debt, this was our cost. After introducing the debt, this is the cost. What does it mean? Capital structure and the cost of capital are not related. That's the conclusion. Capital structure and the cost of debt are not related. Whether you are increasing the debt or not, the cost of capital is going to remain, as long as there is no tax. Is it okay?
Yes.
So what assumption is theory? Assumptions of the theory. Number one is what we have already talked. There is no, we assume an economy where there is no tax, both personal tax, corporate tax, there is no tax at all. We also assume no transaction costs. There is no transaction costs. You can buy, you can sell your shares or your securities. Nobody is going to charge you anything in the market. So we are assuming no transaction costs. We also assume in the theory the market is perfect. We have already explained this. The market is perfect. We are assuming a perfect market. Where there is free flow of information. We assume investors are rational. Investors are rational, as we saw in the previous. So these are assumptions, of course, which are based on to derive this market. So these theories, no tax, no transaction cost, you are having a perfect market which has got a free flow of information, and then we assume that all investors aims at maximizing their wealth. So that is the Modigana and the Mira in a tax-free economy. We have looked at two prepositions. Preposition one, we said value of a GEAD is equal to the value of an GEAD. Preposition two, we have looked and say the cost of capital and the capital structure are not related. Whether you can test this by increasing the value of this debt. you'll find that there is no effect on your cost of capital. Is it okay, friends?
It's okay.
Then going to in a tax economy. In a tax economy. So in our previous, we are looking at Morgan and Miller in a tax-free economy where there is no. Now we are looking at Morgan and Miller where there is tax. So in this theory, considered the effect of debt, the effect of tax on the debt, and developed two prepositions, which are MM1 with tax and MM2 with tax. Still here, what they looked at is the effect of tax on your debt. That if you are financing a business using a debt, the interest you pay on the debt is tax allowable. So because the interest is tax allowable, you can enjoy the benefit of a debt. So still in this preposition, Morgan and Miller, they had two prepositions. Preposition 1, they looked at the effect of capital structure on the value. And the preposition 2, they looked at the effect of capital structure on the cost of capital. But in all prepositions, the conclusion was capital structure, cost of capital, value of the firm are related after introducing the tax. So in summary, if you look at MM1 with tax, that's number 1. MM1 with tax. This analyzes the effect of capital structure on the value of the firm. After the analysis, MM concluded that capital structure and the value of the firm are related. The optimal value the value of a geared business is above the value of an geared business with the debt tax shield. I don't know if it is it becomes understandable at this level. Now, if you look at this MM1, where we are incorporating tax, the conclusion was that the value of a GRD business is always above the value of an GRD business, with the benefit of using a debt, or with the benefit you are saving by using, or by the tax you are saving by using a debt. So now the optimal value, if you look at this, if you're using the Modigliani and the Miller, our optimal value will be equal to VG, or the value will be equal to, that's the value of a GRD. That's the optimal value. Will be equal to VU plus the present value of debt tax shield, where VU is the value of an GRD. Value of an GRD. And PV DTS is the present value of debt tax shield. And how do we get this? This one arises because the interest you pay on the debt is tax allowable. That's what brings this tax shield. The interest paid on the debt is tax allowable. So, because we are assuming that you are going to use the debt in perpetuity, the present value of debt tax shield will be equal to the debt you are using to finance the business times the interest you are paying, that's the interest rate, times the tax. That's the tax shield. Hope we are there. Then this one, because I'm looking at the present value, I divide by the interest. That's the cost of the debt. So meaning that if I simplify this, my present value of the debt tax shield would be equal to the same as getting the debt times the tax. I don't know if you have got me there. So if I substitute up, my VG will be equal to the value of an GRD plus the debt tax shield, which is equal to the value of the debt times the tax. If I can give a simple example here. If I can give a simple example on this. Company X is an GRD. Is an GRD with a current value of 100 million. With a current value of 100 million. The company is introducing debt of 80 million. 80 million. The company is introducing a debt of 80 million. The corporate tax, is 30%. Required. Determine the optimal value of the business. That's number one. Required number one, determine the optimal value. Optimal value of the firm. Number two, determine the effect of introducing the debt on the value of equity. Let's look at that. We shall go on expanding it slowly. Let's first look at this. So if we look at this, what is our data we have? The data that we have. I have a VU, which is my VU, 100 million. I have a VD, a value of a debt, or my D, which is 80. And my T, my tax, 30%. So basing on Modigran and the mirror within this, it means my VG, my optimal value, which is going to be the VG, the value of a geared business, will be equal to the value of an geared plus the debt tax sheet. So this is going to be the same as getting 100 million plus 80 million, which is the debt, times 30%. So meaning my VG will be equal to, if we get it 124, that's going to be the value of this business if I employ the Morgan and the Mira. The optimal value will be 124 million. That's the optimal value of this business. Now, the second question is to determine the effect of introducing the debt on the value of equity. What's the effect of introducing the debt on the value of equity? So, what is the current value of equity now? What will be the VE after introducing the debt? Will be equal to the VG minus the VD. And our VG is 124 minus 80 million, which is the value of the debt. Meaning our VE is going to be, after introducing the debt, what? 44? Now I was a pay. Murimu.
Kubera kuri kwihuta ntabwo
Ndi kwiruka cyane se.
Yeah, uri kwiruka ntitubone umwanya wo gukopinga.
Reka none. So, we are looking at this question. We are looking at this question. We are given the value of the ungeared, and we have the value of the debt. How do I get the value of a geared business? Basing on the Modgana and the Miller, it is equal to the value of ungeared plus the debt tax shield. And how do I get the debt tax shield? I just get the debt times the corporate tax rate. So if I have this data, it means in this case, the value of ungeared, which is 100, plus the debt tax shield, and then I'm going to get 124 as the value of the geared business. So answering the first question, if I'm answering the first question, the optimal value of the firm will be 124. That's the optimal value of the firm. Now, if I'm answering question number 2, it is asking me, what is the effect of introducing the debt on the value of equity? Remember, before introducing the debt, the value of equity was 100 million. That was the value of equity before introducing the debt. Now, after introducing the debt, the total value of the business is 124. So if I reduce the amount of debt I've introduced, it means the value of equity is going to be 44 million. So what does it mean? It means introducing the debt leads to a decrease in the value of equity. The equity holders will look at the business as risky, and therefore they are going to lower the price of the shares. Does it make sense? So that is the mod grant. Can I give you a simple challenge as we are reaching the end? I want to give you a simple challenge. This is example 2. Company X is financing its business with both equity and the debt. The value of equity is 100 million, and the value of debt is 120 million. The company is evaluating introducing a new debt of 50 million. Maybe I reduce this. Let me reduce this to also 50. Is introducing a new debt of 50 million. The corporate tax is 30%. That's the corporate tax required. Number one, determine the value of ungeared business. Two, what is the effect of introducing a new debt on the value? Please tell me that one. At least that one. Then we move on. What is the value of ungeared in this example? Introducing a new debt. Yes, on the value of the business. What is the value of ungeared? So if you summarize it, what's the data you have? Available data. You have a VE, which is 100. You have a VD, which is 50. So it means my VG will be, because this is, I want to emphasize this. This business is already geared because it has got both debt and equity. So it is a geared business.
Yes.
So it means my VG will be the summation of the two.
Yes.
That's going to be the VG.
Yes.
Because it's a geared business. Now,
then the third shield will be on new debt.
What will be the value of ungeared? That's the first question.
The value of ungeared?
Yeah. VG?
Yes, you can look for a debt shield.
You have it here.
Yeah.
So it means you'll have how much? If you put this one, you substitute.
Yeah.
150, isn't it?
Yes.
Equal to VU, we don't know it. Plus our debt is 30, is 100.
Yeah.
The debt is 50. Huh? The debt is 50 times 30%. So from this, what is the VU? 135? Is it 135?
The second question, Lecturer. Is it the effect of introducing a new debt on the value of business?
On the value of the business, or both the value of equity and the value of business. You can input that. What is your VU? Members, you are
135 million.
135 million. Now, what is going to be the new optimal value after introducing the debt? New optimal value after introducing the debt. What will be the new optimal value after introducing the debt? Irabanga VG is going to be equal to
135 plus 50.
135 plus 50 or plus 100, because the debt is becoming 100 now. Isn't it? The debt is becoming 100. You had the 50. You have introduced a new debt of 50. Are you getting it, friends?
Yes,
Or
it will
the,
become
sir.
100.
the sugar is reduced.
Mhm.
The sugar is reduced in the body. So you have what? 165.
Yes, 165.
That's going to be the new value.
Yes.
So what will you answer part 2?
Why do you take 100 once again?
Because first we had a debt of
50.
50. We are introducing another debt of 50.
But we already treated the first 50.
But the current debt is 100 now. So you recognize the total debt.
Ntitwari twayikoresheje iya mbere 50 ya mbere.
Twayikoresheje edufasha gushaka value of ungeared. Nuvuga muri 130 na debt rimwe.
Okay.
Yego. There is no debt. So how do you answer the second question? What is the effect of introducing a new debt on the value? Members, look, compare this. This is the new value. This was the previous value. Are you getting it? Kona babuze. Ntabwo ndi kubumva.
Turare.
Ntabwo muri kunsubiza. Umeze nk'aho bamaze ku isukari yashize.
Irimo gushiramo n'ibyo. So that means that after introducing the new date,
The value has
the value
increased.
of the farm has increased.
Yeah.
Yes.
Introducing a new debt leads to an increase in the value of the farm by how much? By 15 million,
By 30.
Is it start to 15?
No.
This and this.
It is 15.
Oh, 15.
Million. So in a summary, I think we are remaining with the preposition 2, which we shall look at it, I think, in our next class, and then we'll summarize this. MM2 with the tax. I don't know if you have a question on this. Will I send the Excel after the class on Sunday, because it's not finished?
Oh, this one.
It's better you send it now.
Okay.
Because there is something we did not copy about.
Yeah, it's correct to send it today.
Okay. Okay, so let me send you the part we have done. Maybe the complete we shall do it up on Sunday.
Okay.
So have a good evening and a good
Sunday afternoon.
Sunday, I think the whole day.
Yeah, the whole day.
Yes.
It means that we will start from at 8.
Saa mbiri n'igice.
Sande tuzatangira sangahe?
Saa mbiri n'igice.
Saa mbiri.
Very nice. Very nice.
Twihuta ko igihe cyatushiranye. Reka twihute.
Very nice rwose, tuzatangira saa 2:30. Very nice.
Okay, so let's meet on Sunday. I'm going to share the Excel in the.
Okay. Bye.
Bye.
Bye.